Good afternoon. It is December 18th. This is Robert Rayburn here at Life Pro Asset Management. I hope that everyone had a great and fantastic weekend. It certainly was a huge week last week as it related to market developments, Federal Reserve policy, what they said, what they didn't say, and ultimately the favorable impact we saw across the board within our portfolios, outside in the broad market. And we're going to go through what all of that means. And when we take a step back and we look at the fact that the Federal Reserve did pivot, we didn't think they would pivot. And in an ironic way, it actually makes our call as it relates to 2024 and that rotation into value and that rotation into cyclicality and that rotation into assets that benefit from higher interest rates, in our opinion, more likely. And we're going to go through why that is, because to get rates higher, to get nominal growth higher, you actually need easy policy on the short end of the curve. So in other words, a steepening of the yield curve. So we'll go through what all of that means this week. So let's go ahead and share a screen here. So as we can see here, the title of this week's presentation is pretty easy. It's pivot, right? That's the name of the game as it relates to the Federal Reserve last week. So we're going to go through what that Fed pivot means, whether or not that provides fuel for inflation in 2024, and then lastly, allocating for that cyclical reacceleration. So whether that's through banks or energy, commodities, consumer, we're going to go through all of that. Now, as it relates to the broad market, one of the things that we would like to mention is that the S&P 500 did break out here. Again, not at an all-time high, but again, breaking out of that consolidation that we saw going all the way back to the summer and on very strong volume. And what we also saw was net 20-day highs reach 66%. So in other words, what does that mean? You have a breakout to new 2024 highs. It's backed by strong volume and it's backed by strong overall market participation. That's what we want to see. As we look at how the portfolios are positioned, we are down cap. In other words, we're looking at the average stock, those average stocks that are more cheaply priced than the FANG or Magnificent Seven or whatever you want to call that larger group at the very top. And you can see technically what's happening here. After a long period of underperformance, and certainly that was part of how our portfolios were designed, is for the average stock. We did suffer some of those headwinds as it related to relative performance. But now you can see this last week, the week before, this very strong breakout relative to the cap weight, right? So S&P equal weight relative to the cap weight breaking out. We see the same thing even within the NASDAQ. If we look at NASDAQ equal weight relative to the cap weight, again, a strong breakout to the upside. Russell 2000 relative to the S&P 500. Goes back to our call of we prefer small caps over large caps. And then again, the triple Qs or the NASDAQ relative to the Magnificent Seven. So there's a consistent theme here, and that is by the Fed pivoting, you remove or you at least reduce your recession risk. And then as a result, you want to rotate into cyclicality, those stocks that have been pinned down because of this incessant fear over recessions over the last 2 years. So what specifically happened? First, Fed Chairman Jerome Powell did indicate a pivot as it relates to potential Federal Reserve policy in 2024. In other words, they're going to pay more attention to the second part of their mandate, which is growth and employment relative to inflation. Now, that's what they're saying today. Now, remember, growth and employment were their primary focus in November of 2021, right before they had to dramatically repivot again back toward inflation as inflation spiked up. So that's how they're positioning it today. What we want to understand is, based on this policy pivot, what is going to be the impact to the economy, to markets, to liquidity, to cost of capital, and what does that do to inflation in 2024? What are the side impacts or the derivative impacts of that policy going forward? The futures market is now implying a near certainty, 98 to 99% likelihood of Fed rate cuts in March of next year. and then 5 additional 25 basis point cuts in 2024. Again, a significant shift in market expectations. These are fluid, right? So you can have a Fed futures expectation of a cut or 4 cuts, and then if data goes the other way a month from now, that can be reduced to 2 cuts or no cuts or rate hikes. So it's all fluid, but that's sort of what's been driving asset prices higher as it relates to Federal Reserve policy. And remember, the Fed has 2 mandates: control inflation and keep unemployment low. They kind of run against each other a little bit, because as you keep unemployment low and the labor market's tight, wages go up, and that drives inflation. So it's a fine balancing act that the Federal Reserve has. It's actually one of the only central banks in the world that has this dual mandate. The ECB, they have a strict mandate of just keeping inflation under control. There's pros and cons behind both. So what do we know? What we do know for 2024 is that fiscal spending is set to accelerate. So when we look at the Inflation Reduction Act, again, a ridiculous name for an act that dramatically increases government spending, but we know that the vast bulk of that bill as it relates to fiscal stimulus is set to turn on in 2024. That's by design, and there's no coincidence. It's an election year. So the incumbent Republican Democrat, they tend to increase spending during election years to drive up nominal economic growth. That tends to also cause inflationary pressures, right? So we're trying to look through what the market's not looking at right this very second. And then, of course, Japan's abandoning their zero interest rate policy, which will also have a knock-on impact in terms of global bond markets. And the reason why we got to do our homework now in December and try to allocate assets the right way is that we know that we've been in this situation before, which are the 1970s, right? So this chart here on the right shows the CPI index, or the inflation index, in the 1970s. We spiked in the late 60s, early 70s to 6.2%. Fed responded, but then they let their foot off the brakes a little bit too soon. And guess what happened? Inflation accelerated to 12.3%. They did the same thing and again lost their nerve, and then inflation reaccelerated back to 14.8%. Inflation tends to go in waves when we enter into these periods. It's not one consistent glide path toward a final peak. And so I think right now, one of the concerns that we would have is if government spending is accelerating and the Federal Reserve is starting to communicate a less restrictive monetary policy in the form of lower policy rates, well, then growth expectations are going to start to rise. And that feeds into inflation expectations in the future, not today, but in the future in 2024. And if that happens, then your long-term rate expectations also start to rise. And if this happens, we expect value, small cap, to outperform growth and large cap. And what's interesting is you actually look at the areas of the market that outperformed last week: energy, banks, regional banks, consumer. Those areas that would actually tend to and historically have outperformed during a rising rate period that's accompanied by accelerating nominal economic growth. So what is the market really trying to tell us there with those types of symptoms? So for that framework for 2024, we do see that government spending accelerating, growth expectations rise, which then feed into inflation expectations, which then feed into higher rates. When we say higher rates, I want to be very specific: higher long-term rates, not higher policy rates. We actually think what the Fed is now starting to do is steepen the yield curve. And if that happens, that's very, very good for the banks. And then, of course, value small cap over growth and large cap. We see that in the technicals as well. Value has subtly and now more directly started to outperform growth. So when we look at the Russell 1000 growth relative to value, we see that has hit a triple top. And what we're also paying attention to is that the Russell 2000, those small caps, value has really started to outperform. So when this line goes down, it means value is outperforming growth. Vice versa, if it's going up, growth is outperforming value. By this line going down, it's indicating a shift away from growth and into value or those cheaper areas of the market. And that makes sense when we think about things. If the Federal Reserve is shifting away from trying to tone down risk on activity and making monetary policy less restrictive, well, then your recession risk is starting to fall with that. And if that's the case, then a lot of these sectors that are more cyclical and have been discounted from a valuation basis point relative to the S&P 500, you start to see those stock prices rise, and you have to sell some of those stocks that people have been hiding in to buy those, right? And so that's a lot of what we think is going on. And under the surface, value has held up pretty well despite its underperformance this year. It went up about 156% in 2020. It went down about 27%, but less than growth, which went down 43%. And it's much closer. It's only about 18.5% away from its peak relative to growth, which is 40% off its peak. So that shows that relative outperformance through the cycle, right? So when we're thinking of cycle to date versus year to date, we prefer to look at cycle to date. And that's where we see value really showing how well it's performed through the cycle. And again, you can see that with banks. Banks are breaking out relative to technology as that yield curve has started to steepen. Again, what is the market trying to tell us? So these are the areas that we're focusing on as breadth expands. Energy stocks, we see that clear cyclical leadership from areas like energy or commodities such as copper. Bank and insurance stocks, durable and emerging consumer brands, because you need that increased spending as rates come down. There's a little bit more wiggle room there for the consumer. And then, of course, small caps over large caps. So summary here, focus on price, focus on value. What are those areas of the market that did not participate in the rally earlier on this year? We see a rapid catch up in those areas and potentially a relative performance breakdown by those areas that led earlier on in the year. We do believe that the Fed pivot does set up for a cyclical acceleration of growth, which then sets us up for higher inflation expectations and higher long-term rate expectations in 24. That, we believe, starts to steepen the yield curve and starts to, again, reaccelerate that movement away from growth and into value. So that's what we got for you this week. 888-543-3776. If you have any questions, please feel free to reach out to your advisor and have an absolutely fantastic week. Thank you.